Welcome to the Deep Dive, where we cut through the noise to get to the core of what's truly moving the needle in global markets. And today, well, we've got a really fascinating story unfolding right before our eyes. The surprising turnaround of the US dollar. For a good half year, the buck seemed stuck, didn't it? In a relentless downward spiral, consistently hitting new lows, but suddenly, almost like someone flipped a switch, things are looking very, very different. So this deep dive is all about understanding the powerful forces behind this dramatic shift. We're going to unpack how the dollar is not just recovering, but really flexing its muscles again. We'll look at what specific, maybe overlooked events are giving it this crucial tailwind, you could say, and also what critical economic data points are right on the horizon that could determine its next big defining move. You might think you know the dollar story, but this recent chapter has some unexpected twists.
Absolutely. And our mission here is really to distill the core insights from, the latest financial analyses, market commentaries, basically give you a crystal clear, comprehensive picture. We want to help you see beyond just the daily headlines to truly grasp the underlying economic currents at play and understand the potential implications of this sudden, impactful currency reversal, not just for your portfolio maybe, but for global trade investment. It's a complex, interconnected dance, and we're here to guide you through its most important steps.
Okay, let's jump right into this unexpected comeback then. We're focusing on the US dollar index, the DXY, which is essentially the dollar's report card against a basket of 6 other major global currencies, the euro, the yen, the pound.
Suspects.
Exactly. And for a full 6 months, January through June, the DXY was consistently in the red, just couldn't seem to catch a break. But this month, something remarkable has happened. It hasn't just bounced, it's made a significant, really noticeable leap upward, reversing that whole extended decline.
And what's truly astonishing here is the magnitude of this shift. It's not just up a tiny bit. The DXY has recorded a robust 2.1% gain this month already.
Wow, 2.1%.
Yeah, and if it holds, this will mark its first monthly gain since way back last December, snapping that half-year losing streak. What's more, this trajectory puts it on track for potentially its best July performance since 2019. And some analysts are even saying it could clock its biggest monthly gain in 6 years.
6 years. Okay.
Which immediately raises a crucial question for anyone following the markets. If the dollar is capable of such a strong, sharp rebound, what exactly pushed it into such a prolonged slump in the first place? And why did that sentiment just poof, reverse?
That's a great point, because it really feels like we were living in a completely different financial landscape just a few weeks ago. The prevailing narrative, the story that largely drove the dollar's earlier pullback, was built on 2 main pillars, wasn't it? First, these widespread expectations of, pretty aggressive Federal Reserve rate cuts later in the year. And second, increasing signs of a softening labor market here in the U.S., which suggested, our economy might be slowing down faster than people thought.
Right, both classic factors for a weaker currency.
Exactly. But here's where it gets really interesting, almost paradoxical. This current powerful rally for the dollar is happening, even as those underlying rate cut expectations haven't completely disappeared.
Still kind of lingering there.
Right. Many still anticipate some form of easing later in the year. So if the conventional wisdom around Fed policy isn't the primary driver for this newfound strength, what else is truly at play here? What variable changed the whole equation?
That's precisely the puzzle we need to solve. And if we connect this to the bigger picture, the single biggest, most immediate catalyst, the thing that really seems to have sparked this reinvigorated demand for the dollar is a recent landmark trade deal, the one finalized between Washington and Europe.
Okay. That deal.
Yes. And this wasn't just another routine agreement. The market's perception almost universally was that this deal was heavily favorable to the U.S. From what we've gathered, the specifics involved a significant reduction in some long-standing trade barriers, particularly for key American agricultural and technology exports going into European markets.
Okay, so easier access for U.S. goods.
Exactly. And that move is seen as directly boosting forecasts for U.S. export growth, which, by extension, strengthens the outlook for overall U.S. economic resilience. When investors see a nation's exports poised to grow, it signals a healthier economy compared to its trading partners. And that naturally makes its currency a more attractive asset to hold. Simple as that sometimes.
And this perceived advantage had an almost instantaneous effect, didn't it? Direct, quite dramatic impact, particularly on the euro.
It really did.
We saw a stark illustration of this earlier this week. The euro took a pretty sharp 1.3% single-day hit against the dollar.
A big move for currencies in one day.
Huge. And it happened literally hours after the key details of that trade news broke. That really highlights the immediate market reaction. You could almost see investors repositioning themselves.
Pulling capital out of euro assets.
Yeah. And flocking to the dollar in response to this perceived shift in economic advantage. It's just a powerful demonstration of how global trade policy can ripple through currency markets so swiftly.
It is. But despite this impressive recent surge, it's really important for us and for you listening to maintain perspective. We shouldn't get too carried away by just this short-term bounce.
Right. Context is key.
Exactly. The dollar's overall gauge, even with this nice monthly gain, still remains down roughly 10% year-to-date from its highs earlier in the year.
So still quite a bit lower overall.
Quite a bit. And this underscores a critical point for understanding long-term currency movements. While the current rally is certainly significant, it's noteworthy. The path to fully reversing its deep long-term bearish structure, that 6-month decline we just discussed, which built up a significant amount of negative sentiment, a lot of short positions against the dollar, that path is going to be a steep climb.
Okay, explain that bearish structure idea a bit more.
Sure. When we talk about a bearish structure, we essentially mean that for half a year, market participants have built their expectations and positioned their portfolios around the idea of a weakening dollar. That was the trend. Lower lows, lower highs on the charts. Reversing that deeply ingrained sentiment and that technical picture, it won't happen overnight. It needs sustained positive catalysts. It needs a fundamental shift in the economic outlook to truly undo months of negative momentum and establish a genuinely new bullish trend.
So it's a strong short-term bounce, potentially, but the underlying trend needs more proof, more fuel to truly reverse course.
Precisely. More than just one good month.
Got it. That distinction between a rally and a full trend reversal is crucial. So looking ahead, it sounds like there are still some major tests coming up for the dollar. Hurdles it needs to clear.
Definitely.
And you mentioned two significant ones on the economic calendar coming up fast. First, we have the Federal Reserve's highly anticipated upcoming rate decision.
Always a big one.
Always. Right now, markets are largely pricing in no change to rates at this particular meeting. What that means, for anyone maybe newer to this, is that traders have already adjusted their strategies, their asset valuations, based on the overwhelming expectation that the Fed will not move rates at all this time.
It's already baked into the cake, so to speak.
Exactly. So if the Fed does exactly what's expected, the market's reaction tends to be relatively muted, right? Because that outcome is already built in. However, the market is still anticipating a potential resumption of rate cuts, perhaps as early as September. So the focus shifts to the future path.
And this raises an important question for us to consider. What if the market's current expectation isn't met? What if there is a surprise? Or, perhaps more likely, what about other key data that could fundamentally shift perceptions, regardless of the Fed's immediate decision?
Like the jobs report.
Exactly. That brings us to the second critical event on the horizon, the upcoming non-farm payrolls data. This jobs report is always, well, it's a sight to behold for market watchers and traders.
It really dominates the headlines for a day or two.
It does, because it offers such a clear, immediate snapshot of the health of the U.S. labor market. But it's more than just the number of jobs created or lost. It's a key barometer of consumer health. And consumer health, as we know, drives about 70% of the U.S. economy.
Right. Jobs mean spending power.
Precisely. Strong job growth signals higher wages, potentially more spending, maybe even inflationary pressures down the line. Conversely, weak job growth signals slowing demand, economic cooling. This direct link to consumer behavior and inflation means the non-farm payrolls report directly influences the Fed's future decisions. It hits right at their dual mandate of maximum employment and price stability.
Which is why every analyst, every trader, every policymaker is absolutely glued to this report each month.
You bet. It's crucial.
Okay, so bringing it all together then, what does this mean for the dollar, especially with these two huge events looming? Well, let's think about the scenarios. If we see a significant miss on the non-farm payrolls, meaning job growth comes in much weaker than everyone expects, that could very quickly revive dollar selling, couldn't it?
Almost certainly.
Such a report would sharpen concerns about the underlying U.S. economic momentum,
Right.
maybe signal a slowdown is really taking hold.
Yeah.
And it could quickly undermine the confidence that recent trade deal helped build.
Could pour cold water on the rally, yes.
On the other hand, what if the Fed holds rates steady, just as expected? No surprises there. And the jobs data remains solid, shows continued resilience, strength in the labor market.
That combination, That could be powerful.
Right, that combination could provide the greenback with the crucial second wind it needs.
It would help solidify its recent gains, prove it's maybe more than just a fleeting bounce.
And potentially pave the way for a more sustained reversal of its previous bearish trend. Feels like a real high-stakes moment for the dollar right now.
It absolutely is a potential turning point.
So there you have it. We've seen the dollar defy its prolonged 6-month slump. Fueled, it seems, largely by a significant trade deal that reshaped market perceptions, and also by this shifting landscape of broader economic expectations. The immediate future, for better or worse, clearly hinges on the Fed's upcoming decision and the strength or weakness of that critical jobs report. It's such a dynamic currency, always reacting to new information.
And understanding these deeply interconnected factors, I mean, everything from the fine print of international trade agreements to the intricate details of domestic labor statistics, gives you a powerful shortcut. A shortcut to being truly well-informed about global currency movements. It's not just about memorizing the numbers themselves like the DXY level. It's about truly grasping the specific catalysts, the critical data points that cause those numbers to move, and how they influence the larger economic narrative.
Yeah, connecting the dots. And for you, the learner, this deep dive hopefully highlights just how profoundly complex market dynamics are, how they're often influenced by very specific global events and these highly anticipated domestic economic reports. It really shows that even a seemingly predictable trend, like that dollar slide, can be upended by a single significant piece of news. So, as you consider this intricate interplay, between international trade deals and crucial domestic job numbers, how might these factors continue to shape not just the dollar's value, but broader economic confidence and investment flows in the months to come? And maybe what new unexpected catalyst might be just around the corner to once again shift the dollar's trajectory? Something to think about.